Good morning, everyone, and thank you for joining us this morning for Data and Insights 3 farm financial measures to monitor in 2023. We acknowledge that we often ask customers for a significant amount of information from time to time, but we are hopeful that you see the returned value in providing the information that you do. The goal today is to share with you how you can use those financial analysis or statements to make informed decisions as we head into the 2023 crop year. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenters today by using the chat feature at the bottom of your page. As you can see on the screen, there's 2 different ways to do this. If you are on mobile, go ahead and select the 3 small dots and then select chat. Or if you are joining us from a desktop, go ahead and select chat on the far right side of your screen. Before we begin, I'd like to introduce our experts today on the call. First off, Mr. David Widmar, co-founder and managing partner of Agricultural Economic Insights, and our very own Ashley Hopp, senior financial officer from the Rensselaer, Indiana office. As a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. So any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. So with that, thank you so much for joining us this morning. We're going to get started with our presentation and we'll jump into questions that you all may have starting at 10 o'clock. So this event is going to be recorded and distributed following the webinar. And you're welcome to go ahead and put those questions in throughout today's webinar, but we will get to all those questions that are asked starting at 10. So with that, David, thanks for joining us and go ahead and take it away, my friend.
Well, thank you so much, Micah, for that introduction. Thank you all for joining us. I have to admit, Brent Gloy, my business partner, the other economist who joins us for these events, he's actually dealing with a blizzard and a power outage. So we have some redundancies here with multiple economists, so we will proceed here. But today's topic, I think, is really, really important because it's that time of the year where we're closing out 2022 financial records, preparing for that obligation of filing taxes, and we're starting to also make plans for 2023. It's sort of this inflection point in a lot of our decision-making processes, in a time of reflection, but also planning ahead. And I think the goal of today's conversation is to really help you start to sort through all of those records and start to focus on a few areas that you can dive deep in on your own farm records and start to make some better decisions and make some more confident decisions heading into 2023 by using your financial records and financial information and financial metrics. I always remind producers that if it weren't for having to file for taxes, a lot of us would have really, really poor financial records. And we want to figure out a way to make sense of those financial records. We just don't want to put all that effort in just to file taxes. How do we turn that into something more insightful? And what's really exciting about today's webinar is we have Ashley on board, and she's going to help us kind of share that perspective of the lender. And so you can also kind of triangulate between our conversation around these 3 metrics to keep in mind, but also how a lender would think about this and how you can prepare for conversations with your trusted financial advisors as we move forward. So how do we make decisions with these financial measures? There are dozens of these. I spent a lot of time at Purdue University, so I'm really good at the academic sort of sharing dozens of these metrics, but we boiled it down to just 3 metrics, and we're going to talk about those during this 30-minute discussion. And today's conversation is going to cover working capital, the debt coverage ratio, and earned versus unearned equity changes. These, we think, given where conditions are in the farm sector, given all the uncertainty that we're facing, are 3 metrics that are important for the sector, but also worth you spending just a little bit of time. Now, admittedly, you might have different concerns, different ratios that you're watching. Maybe your lender is going to talk with you about different things to keep an eye on or different areas to improve, but these are 3 that are worth getting started. So before I dive into working capital, I want to introduce real briefly Ashley, and thank you so much for your time today, but also in preparing today for this, Ashley. To kick this off a little bit, could you tell us a little bit about yourself and your role with the association?
Sure, David. My name is Ashley Hopp. I've been a financial officer with Farm Credit Mid-America for about 10 years in our Rensselaer, Indiana office. I was born and raised in Rensselaer. I'm a Purdue graduate, and I'm very fortunate because my office is only a few miles away from my family farm. So my husband and I both work off the farm, but we are actively engaged wherever we can be. We have 2 daughters, Hadley's 12 and Emmy's 8. and they enjoy helping on the farm as well. I have to admit, David, I was on vacation last week and I came home with a nasty flu bug, so I'm not looking or feeling my best. So I apologize for my video being off today, but nevertheless, I'm really happy to be here and be part of this discussion.
Well, we appreciate your joining and you helping us prepare for this, but also the insights you're going to share. So I've teased this up a little bit. I said we're going to talk about working capital, debt coverage ratio, and earned versus unearned equity changes. But there's a little bit of arm wrestling going on amongst you, myself, and Mike as we were preparing for this. I'm curious, putting that lender hat on, but also that experience as a producer or experience with your family operation. Which ratio or considerations, are you carefully watching heading into 2023? If you had to pick just one.
Well, it's really tough to pick just one. I think there are two that are really top of mind for me right now, and that's liquidity and debt coverage ratio. Debt coverage ratio is always going to be important because Farm Credit is an earnings-based lender, so repayment is something that we're always going to focus on. Margins have been really strong for these last few years. When we add 2022 into our average, it's going to look even better. So, we want to be making sure that we're careful when we're planning purchases and things like that based on stronger than typical income or margins. But I think if I did just have to pick one right now, it would probably be liquidity. Most balance sheets are really strong right now, David, and many growers have built substantial working capital positions over the last few years. But let's face it, everything costs more than it used to. I don't see inputs getting cheaper anytime soon, and prices will probably soften at some point in the near future. So as I'm meeting with borrowers right now this time of year while they're doing their pre-tax planning and projections for 2023, we're talking about the importance of retaining some of that liquidity. So that way, when things do get a little bit tighter, they have reserves and they can adapt.
And I'm just going to springboard off that conversation, and we're going to jump into one of those measures of liquidity. And I think a good starting point, oftentimes, for measuring liquidity is simply working capital. And how do we measure working capital? Working capital is the difference between those current assets we have on the top of our balance sheets and those current liabilities we have towards the top of our balance sheets. And the current assets, current liabilities, these are the assets that we can convert to cash in the next year. So maybe grain that we're planning to sell, maybe it's some prepaid expenses that we have in store for 2023. Maybe it's livestock sales that we have planned or intend to make. Maybe it's cash on hand as well. That's another important form of current assets. The current liabilities are those liabilities that we anticipate that we're going to need to pay. So maybe it's some expenses that accounts payable that we have that are outstanding. It could also be so we're talking about current liabilities. It could be accounts payables. It could also be the current portion of debts that we have to service. So maybe it's a land payment that we need to make, or those lines of credit that we need to make pay off as well. So these current portions, the next year that we're thinking about. And the difference between there is just a dollar measure of working capital, total dollars of working capital. And there's some different ways we can start to slice and dice that working capital measure as we want to get even more insights. But I think just capturing total dollars of working capital are really, really important. Again, this is a margin of protection after all short-term liabilities are paid. I always like to remind folks working capital is the original form of risk management. Working capital is not a risk management tool that we can go out and buy, but it's one that we can build into our financial balance sheets. It's ones that we can create a goal around that we can build and maintain over time. There's different strategies about how much working capital we should have. There's different preferences about how much working capital any operation should take on. But I think it's really important just to understand where your working capital positions are and what the trend has been. So here are a couple looks at the working capital trend at the sector level. Again, this is across all farms in the entire United States. And as you can see, working capital has been building the last couple of years. We anticipate that there was about $60 billion of working capital at the low point back in I believe that was 2016, and then it stayed pretty low there for during the trade war in the early years of the pandemic, and then we saw a big bounce. We're above 120 billion, so about twice as much working capital in the farm sector today as there was just 5 or 6 years ago. But keeping in mind there wasn't nearly as much working capital today as there was back in the last boom. We got over $160 billion in total sector. So start thinking about what this might look like for your operations. If you've been keeping balance sheets for multiple years, you can go pull those out and you can start to make those calculations to track your working capital on a total dollar basis. Another way we can measure this is on a dollars per acre basis or dollars per head of livestock basis. Again, I think that's also important to keep in mind, especially if we're setting goals. The slide to the right here is another really helpful measure. This is working capital to gross revenue ratio. This is a relative measure. So how much working capital do I have relative to income that my operation generates? So this is going to help us understand, are we keeping up with these higher costs of production, these higher commodity price environments? And as you can tell here, working capital got pretty darn low back in 2016 to 18, around 15%. So if there's $100 of anticipated revenue, there's $15 worth of working capital available on the balance sheet. So if things get really bad, we can count on the balance sheet's working capital about $15 worth of shock absorber. That got better in 2021, got close to 25. But as we can see here, it's starting to drift a little bit lower. Why? Well, working capital is a little bit sideways, but we also have higher revenue because of higher commodity prices. So we got to think about, how do we make sure we keep up in these higher periods? The Farm Financial Standards has a scorecard here that's really, really handy. They have three colors: a stoplight, red, yellow, green, and they put these metrics about anything below 10% working capital gross revenue is a concern. 10 to 30% is yellow, caution, and levels above 30%. I want to reiterate, this is going to vary for types of operations, for where you are in your career, where your operation is in the life cycle. If you're thinking about transitioning, if you're thinking about growing, things like using crop insurance can adjust how much working capital is sufficient. So again, know where you stand on total dollars, know what your trend has been, and then start to make a goal based on these scorecards and where you want to be based on your future plans. So a few questions to ask yourself: what has been the trend, as I mentioned? Where are your working capital needs? And then really work with your financial officer, your lenders, and really put together steps and a plan that can help you improve your working capital position. Again, and when we think about commodity prices potentially turning lower, we think about this high cost structure, working capital can be a really valuable tool and asset. So I want to ask Ashley to come back in and provide that lender perspective here. I'm curious, Ashley, can you share an example of how producers can use these insights around working capital to make some decisions heading into 2023?
Well, David, 2023 really should be no different than any other year, right? Good managers are evaluating how to use their working capital year in and year out. It's part of their business plan. Given the high cost per acre currently, retaining working capital is going to be key in being flexible so they can make adjustments quickly. For those that have a strong liquidity and solvency position right now, they've got a lot of long-term and short-term options. If growers are tight on liquidity, they're going to have to find different ways that they can unlock that short-term capital. One thing that I've been working on with borrowers lately is making sure their line of credit is adequately sized. Some of them haven't been using their operating line as much lately, and so we want to make sure that's right sized going into 2023. We're talking about cash versus financing of purchases. So interest rates have to play a factor in that decision, but we also want to be sure not to deplete working capital and eliminate the operation's short-term risk-bearing ability.
Well, great. I really appreciate that. That's really, really helpful. I think another way, as I was thinking about that, as you said, that is sort of alternatives, right? There's sort of decision A versus decision B. Maybe we buy a new tractor, or maybe we defer that decision. Thinking about working capital can be another data point that really helps us better size up alternatives and options that we might have to make here in the next few weeks and months. Shifting gears just a little bit, to the next level, we're going to talk about the debt coverage ratio. We're going to start off with how we can measure this. And as we were preparing for this, Micah reminded us that this is one of those metrics that you don't really want to pursue as a DIY. You really want to make sure that it could be helpful to have your financial officer help you work through this, because there's a lot of moving pieces, and there's some standardization that happens, but the standardization varies quite a bit by operation and by entity type. So let's just talk about what really goes into this debt coverage from a high level. Again, encourage you to work through the financial officer to plug in your farm specific numbers. Is the goal for debt coverage ratio is to think about how many dollars of debt payment do I need to take care of in the next year or in the past year? That's the bottom part. That's this total interest plus term principal payment. So how much do I need to service? And then at the top, it says how much income do I have to pull that off? How many dollars do I have to pull that off? So you're going to take that total farm income coming maybe from a Schedule F. You're going to subtract away the family living and income taxes. So we're going to say, okay, how many dollars are really truly available for me to service? And oftentimes family living expense, or that portion that gets pulled away from the operation to meet our family living expense obligations, isn't available. Same with the income taxes. Then we get to add some stuff back in. We get to add in depreciation. That's a non-cash expense. That is a tax tool, so we get to add that back in, and we get to add back in the interest, because that interest comes back in on the bottom part of the equation. So it's, again, how many dollars do we have available to service debt when we account for income, family living, taxes, and depreciation and interest? And then we say, okay, how much do I need to, how much of my obligations in terms of term interest and term principal demand? And that's going to give us this metric of, how much flexibility do I have in that income side? How much of my income or free cash flow am I utilizing? There's a scorecard metric, again, that's really important to keep in mind. Anything less than 1.2. So when you have a ratio that comes in less than 1.2, then that's a pause for some concern. If you're in the yellow, 1.2 to 1.5, and then green is having about 1.5 as much income as you do for debt obligations to service. So red, yellow, and green there. So to consider here in 2023, I think this is a really important idea to keep in mind as we're sitting in 2023 and all the uncertainty around where commodity prices might go and where the future might be is, what happens if income declines? What happens if commodity prices significantly adjust? If you think back to that equation, the bottom part, term interest and term principal payments, that's kind of locked in for our 2023. What's unknown here is potentially how much income we have. And so as we start to think about expansion plans or upgrading our equipment or buying that next piece of farm ground, this can really impact the denominator, and we want to make sure that we can really keep an eye on that as we move forward. The second piece to consider is if you want to make some improvements here in 2023, can you rebalance that current versus long-term structure of the debt? Maybe we're servicing this farm loan that we made a few years ago. Maybe we're servicing it a little too aggressively. Maybe if we term those payments out a few more years, we can get the annual payments down. That can improve our debt coverage ratio. Maybe we can limit our off-farm withdrawals. Maybe there's a way that we can offset those family living with some off-farm income. Maybe that's a way for us to create some balance there. So again, know where you're at, create some trends about where things have been going, and then put together a plan with your financial officer for 2023 and moving ahead. Ashley, I want to bring you back in here. I'm really curious about producers using their 2022 debt coverage ratio data when thinking about the decisions, such as maybe buying a new tractor, when the income story for 2023 is still pretty unknown. How can they start to plug in some what-if examples there?
Sure. So I think when we're trying to make a decision on a capital purchase, we should look at historical profit margins and do our best to project for the upcoming year, not just make those decisions based off of 1 year's earnings. We need to make sure that we have a good understanding of the operation's fixed costs, their variable costs, and also the family living expense. I think that is key. We also need to estimate the overall break even. And then from there, we can utilize risk management tools to help protect profit margin. So as you've mentioned, I mean, you've put in a lot of plugs for working with your loan officer already, David, but our loan officers have tools available and would be happy to sit down and help our growers, calculate their break even if they don't do that already themselves. We can also run stress test scenarios. For example, what would the margin be if revenue declined by 10% or expenses increased by 10% or even both? So we can apply this to interest rates as well, given the current environment that we're in. So what would a 2% increase in interest do to the overall margin? So I think it's just important to sit down and, stress test each of those different types of scenarios.
Yeah, it's really helpful. I really like how you mentioned and underscored that family living. I always say, if there's two farms that are across the street from each other, they both farm 1,500 acres or 2,000 acres of corn and soybeans, their total income could be very, very similar. Maybe even the equipment they have is very, very similar. But one of the differences that could be very, very different is how much the family is relying on the operation for family living expense. And that can really impact how much growth that operation can have in the future, or how much there is available for specific metrics like this debt coverage ratio. So really appreciate you mentioning that and sharing some more insights there. So in the last few minutes here, we're going to talk about the last consideration that we've talked about. We think it's really important for you to put on the top of your management list as you wrap up your 2022 financial records and start thinking about 2023 plans and projections. We want to talk about equity changes. And there's a little bit of a reminder, think about that balance sheet equation, total assets, and you have minus total liabilities. That gives you your operations total equity, or that net worth. And we're going to talk about equity changes. One way we can think about how well your year went is you look at last year's balance sheet and you look at this year's balance sheet, or the balance sheet you closed out on December 31st, 2021, and the one you're going to close out here in just a few weeks. How much did the equity change? We can also look at profitability or free cash flow and all these others, but a lot of us could be looking at how much did that equity change? And when we have a year like we have in 2022, this equity changes can start to be a little bit distortive. We want to make sure that we're at least thinking about the best way to approach that. So equity, of course, is the portion of assets that would remain if all liabilities were settled. I think we all kind of intuitively know this, but let's talk about some of the challenges here that are unique to 2022 heading into 2023. What are the sources of equity change? Well, there's one source called earned equity, and that's coming from the income statement. That's changes in income from our operation. It's very much profitability driven. It's the revenues that we had minus the production expenses that it took to raise those crops and those livestock. That's very, very intuitive. What might be less intuitive are unearned sources of equity changes. These can be changes in our asset values. Maybe it's higher equipment values, maybe it's higher livestock values, and especially here in 2022, higher farmland values. So we see data like that came out this summer from Purdue saying that farmland values in Indiana were up 30%. I just saw Iowa came out with another round of data saying those farmland values in that state were up double digits this year. We start to pause and wonder, like, okay, how should we be updating our balance sheets in periods of time when these values are changing? 15, 20, even a 30% change in our farmland values on our balance sheets can have a huge impact on what those equity changes look like across the whole country, across all farms in the U.S. Farmland values account for 80% of all of the assets on a farm balance sheet. So their farmland values have had a big change, and they're a big part of all the assets on our operation. So how do we start thinking about those? Well, the first consideration is mind what we call the wealth effect. This is coming from economic theory, and the wealth effect is this idea that when people feel like they have more wealth, when there's more money on their balance sheets and more money in their checking account, they tend to just spend more money. This means that sometimes our spending behavior isn't completely linked to the revenues or the incomes or the profits that we have to justify those purchases. And so we start thinking about this on a business level. We might say, hey, my farmland values keep going up. I have a lot of equity here. I'm going to go out and buy this next farm or this next piece of equipment. And we might be ignoring metrics like we just talked about, the debt coverage ratio, or maybe ignoring our working capital. We want to make sure that we keep that wealth effect very much in mind. Another consideration, I think this is one that you could work with your team, your family, or your other teammates in your operation, but also your financial advisors. What are reasonable adjustments to make in your balance sheets? One way, if you think about GAAP certified balance sheets or accounting statements, you would sort of put farmland at cost. You would never ever change the farmland value. Well, that's not probably going to work really well for most operations, most farming operations. But at the same time, we really don't want to necessarily be at the bleeding edge of where farmland market is. And there's a lot of reasons why we wouldn't want to do that. One of them is because we don't know where the market's going to be in the next few weeks or months. And so we would hate to put in sort of this the biggest possible number, because it might not be a reflection of what we could get for all of our acres if they went on the market in a short period of time. So keep that in mind. And the other one is sometimes our balance sheets don't reflect those capital gains liabilities that would be due if we were to sell that ground today. So there could be a difference between what we could sell it for and what we'd have left over after capital gains are paid. So those are another consideration. So in general, we want you to sort of think about, how can I put in a value that I'm comfortable with, that's a valuation that I can maybe anticipate for a few years. You wouldn't have to want to lower that very much if the market moved just a little bit, but how do you put something that's reasonable and a reasonable estimate for where you would be after everything's netted out, and even the uncertainty where the farmland market might be in the next 12 months or so. So with that in mind, I want to bring our lender expert back in and ask one question before we get to all your questions through the Q&A portal. I'm curious, do you have any advice for producers, any more specific advice about how they might approach that unearned equity change, given that example I said about farmland values changing so much in the last year and the temptation to mark those up higher?
Well, David, I'm far from an expert in this area, but I'm really glad that we're having this conversation, because this question has come up in so many of the conversations I've had with growers lately. I guess my best advice is just proceed with caution. I agree with everything that you just said. I think representing assets at a reasonable price relative to the market is acceptable. What I just don't want to see is the land value kind of yo-yoing on the balance sheet from year to year. So I think conservative values will help determine the level of flexibility for your financial position for your operation.
Yeah, I like how you mentioned that yo-yo could be difficult. Think about something like the debt-to-asset ratio. If those assets are going down and up and down and up, that could really impact that debt-to-asset ratio and other measures that could be create some stress. You know, you sort of feel really good this year, and maybe you feel a lot of stress, and it could just be small deviations or small adjustments in how we perceive that farmland market to change. So we could kind of proceed with some proceed with that in mind and maybe be a little bit conservative in how we adjust those values from year to year. So thank you so much, Ashley, for your contributions thus far. I'm going to kick it back over to Micah here. We're at that 30-minute mark, and we're going to open it up for all the questions we have from all you listeners.
Awesome. Thank you, David. And thank you, Ashley. We had a few questions come in here privately through the chat. And if you all have additional questions, we'd be happy to entertain those as well. But I'm going to get us started off with a question that kind of falls into this topic overall, David. How important will it be to have cash on hand versus paying down debt? From your perspective, you and Ashley talked a little bit about this from a working capital, and it sounded like it varied, you know, on each operation. But do you have an overall arching trend or perspective that you wanted to share on this front?
Well, I think the fact that the question is being asked is a really great management insight. I think there's this trade-off. Anytime there's cash on hand, there's a demand for it, right? Well, I can pay off this debt and I can not be paying interest expense. And as interest rates are going up, that opportunity cost of having that cash on hand and thinking about, wow, I have this $10,000 in this account and I'm paying, you know, X% interest rate over here, it's been going up, I can pay that off, I can get that. One thing to keep in mind is when we commit those resources to paying off the debt, we've wiped away that debt, but what happens if there's a hiccup in 2023? Maybe there's a big drought. Maybe there's a hailstorm that wipes out a lot of our crop production. If we've paid off that debt and we've used that cash, that working capital to pay that off, we don't have that risk management tool, that working capital readily available. Sure, we can go out and maybe restructure some debt, or we can think about ways to unlock some equity that we have tied up in other assets, but it becomes more difficult. It becomes more challenging. So I think what's really important is to spend a little bit of time this winter with your financial officers, with your set a goal for working capital and say, this is what I'm comfortable with. This is what's my trend has been. This is my goal. And then if we start to have excess working capital, then you can start to make decisions around, okay, should I be saving this to maybe buy the next farm ground, the next piece of farm ground? Is that down payment? Or maybe I am going to start to retire some of my debt a little bit earlier than I initially planned because I'm in this this favorable financial position, and I am worried about interest rates. So to summarize, I think that we should start with the goal and then make our decision as to how we should allocate those additional dollars or those excess dollars of working capital. And retiring debt early is a very good strategy, especially if we're concerned about interest expense.
Awesome. Thank you for that. Another question that kind of came in that is along that line is, what are your thoughts on land values remaining as strong as they have seen, with record land values in the Midwest over the past few years? Do you see that being a trend that's going to continue?
Well, Mike, I think we could have at least an hour webinar talking about that. And I think, we wrote an article the other day and we worked through 3 questions that everybody should be asking themselves when they're pursuing this farmland decision. The first one is farmland the right place to be parking my investments? And if you know that you are trying to create a savings account for healthcare purposes, or maybe just a rainy day savings account, or maybe a college fund savings account, farmland is a great investment, but it has some liquidity challenges. You just can't pull that money out right away. So you need to decide, like, okay, is this the right place to put my farmland? The second, another consideration is this farm a good farm for me to pursue, given the rental potential that this, or the income potential this farm could generate, the values that it could consider as well. And then the third consideration that everyone needs to consider is, how does that opportunity, this good farm that I've looked at, how does it fit into what I can afford, what my balance sheet can justify? How much of a down payment should I put in? What are the terms that this new farm purchase might look like? And so the reason why we structured it this way, big picture, should I be making investments in farmland broadly? Is this the type of farm that I want to make an investment in? Does this farm investment opportunity make sense given my financial opportunities? It really allows us to think through this more strategically, more deliberately, and more carefully. I don't know where the future of farmland values go. The pendulum has been really far to the side that was favored high farmland values. And what were those factors? Low interest rates and high income. And we've had those really, really favorable conditions at the beginning, a year ago in 2022. Moving ahead, it's unclear. Interest rates have risen. That's going to be less favorable than it was a year ago. And the income side, the profitability side, still looks strong. But when we step back, how many years can we anticipate that to happen? I don't know how far the pendulum will swing to the other side, but that's important consideration to keep in mind.
And so, as you just talked about farmland, I'm gonna pitch you up with one last question as far as your outlook per se. Interest rates. Do you have any perspective on what that could look like in 2 to 3 years? And I'm assuming that you have a perspective as to how that would impact land values then too. It sounds like there was
Right.
a connecting dot there.
Right. That's a really great question. I think the first thing to keep in mind is, what interest rate are we talking about? Are we talking about the Fed short-term rate? How many times will the Fed raise rates? Or maybe these longer-term interest rates, maybe the 10-year treasuries, which I think 10-year treasuries have a bigger impact on most of us listening than the Fed's, monthly or every other month decision that they announce. And those longer-term debt markets, they move daily. They don't necessarily move with the Federal Reserve's latest action. One thing that we're watching really carefully is inflation. And we would anticipate, if inflation is going to continue to be strong, if it's going to continue to be high, we would anticipate high interest rates 2 or 3 years from now. So as you're watching, as you're looking out ahead, keep an eye on inflation. If that inflation continues to be high, if it continues to be strong, over time, we would anticipate interest rates to not only match those levels, but start to exceed it. There are some opportunities. One thing we monitor is real interest rates. So it's the interest rates we pay less inflation in the economy. And there have been some measures here in the last 18 to 24 months. We've had negative real interest rates, meaning the interest rates we've paid have been less than the inflation rate in the economy. That is not a trend that we'd expect to take hold or last for several years. In the long run, we expect that the interest rates we pay to be slightly above the inflation rate in the economy. And that's why I say watch inflation. If we see inflation persist at 6% for the next 3 or 4 years, we're going to see interest rates get above that level and stay there. One last comment, Mike, I'll make on interest rates. It's not just that we've moved from low and declining interest rates. That's been sort of this decades long trend. Interest rates keep going lower and they keep declining lower. There's a couple other, so we've gone up and we've seen higher rates, but also the volatility. It's very, very unclear where interest rates will be 2 or 3 years from now. It could be higher, it could be lower. It could be higher and lower to a magnitude of maybe 200 or 300 basis points. I don't really know, but it's the uncertainty, it's the volatility that's also unique. If you think back just 5 or 6 years ago, we weren't really worried about where will interest rates be a year from now. And if we were thinking about 100 basis points. And this year, the Fed's been very aggressive. We're going to probably get really close to 400 basis points or more of movement out of that Fed funds rate. Long answer to a short question, but I hope that's helpful there, Micah.
Very helpful. And so I'm going to continue this conversation. And Ashley, I have a question for you. We have one of the questions that came in was around net per acre you need on 300 acres, let's say. In that profitability piece, that's important. What thoughts or recommendations do you have for the listeners on the call that are kind of wondering about where do I need to be in comparison to maybe where our peers are, or where do I need to be to really make this thing cash flow and work?
Well, Micah, I'm just gonna say, I think that depends on the operation. So kind of going back to something that I said earlier, one of my favorite things to do is to sit around a kitchen table and help a customer go through, their fixed costs, their variable costs, their family living, all of those things, kind of determine that overall break even. And so I don't think the answer to your question is the same for everybody. I think it depends on the operation. And I think we need to kind of sit down and go through, all of that information together to figure out what's the best, answer for them.
Yeah, and I think that's the benefit of having a great relationship with your financial officer, right? Is those conversations can happen pretty naturally and can provide you a lot of resources. So as we wrap up today, I just want to revisit what I said in the very beginning, and that's that we acknowledge that sometimes we'll ask for a lot of information, but we're hopeful that as a result of that information, we're able to go through some of these metrics that David and Ashley discussed today to really make meaningful decisions about where you're headed. And so as you're thinking about where am I at today, as you're thinking about doing that 1231 balance sheet that we preach about so frequently, we hope that you'll start to understand the value in doing those things, because you can sit down with your loan officer, just like Ashley said. You can ask questions. You can start to speculate on your farm as to where are things headed and what do I need to do to be prepared for those things. And so with that all being said, David, Ashley, any last minute closing thoughts before we wrap up today?
I wish you all the best in 2023. I admit there's a lot of uncertainty, but I think there's some optimism out there. We do have favorable commodity prices. The income outlook looks strong. Farmland values are up. So let's not let the concerns, the uncertainties, the high production costs sort of overshadow some of the positive stories that have happened. So best of luck and look forward to catching you on a future episode.
Awesome. Well, thank you all so much for joining. As a reminder, this webinar will be recorded and sent out to all attendees that registered. And so if you're watching the recording, thank you for joining us, and we'll see you on the next webinar here. So we hope you have a very happy holiday season, and we'll see you in the beginning of January. Thank you all.
Merry Christmas.